Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. On today's accounting episode, we'll look at how you can actually take all of those concepts and things that you've already learned about reporting in the financial statements and analyze them when you're looking at a company. Because the one thing that you will have for sure when analyzing financial statements is that you'll look at any company's statements and then you'll see that the concepts I mentioned aren't as visible. Companies are not going to make it obvious for you. They won't have a column that's saying inventory, a column that's saying PPE, a column that's saying stuff so explicitly, but they might sometimes hide it out. So what you have to do is analyze those statements and get the most out of it. And also the easiest way to analyze statements, it's commonly used with ratios. So in today's episode, we'll look at the most important financial ratios for understanding different things of a company's financial health or its operations. So let's start with that part, and then I'm going to go to the analysis of these ratios. As you might know, every industry may have different types of ratios. So the first thing that I should say is that when you look at a ratio, you can't make rushed conclusions, because a company in an oil and gas industry may have extremely different ratios from someone in the tech industry and very different from someone in retail industry. So seeing things about inventory, about cash receivables, about operations will vary depending on the industry. So what you should look for is comparing that ratio either within the company in those years. So how was it compared to last year or 2 years before that or the last 5 years? Or comparing that same ratio but with companies that are going to be from the similar industry. There are many financial ratios. And the important thing isn't really getting to those ratios, especially because today we have lots of websites that might give you those ratios already calculated for you. So if you just go into Finance Yahoo or into Google and you just look for the debt to equity ratio of a company, you'll be able to see it. So I won't go into how to calculate those ratios, but what are they saying about every company? And for this, I'm going to group them into ratios that are going to tell you different things. First, I have a category that's talking about the efficiency of using assets to create revenue. And for this, you might look at two ratios. You might look at the total asset turnover or specifically just at the PPE turnover. The total asset turnover would include all your assets, but what other people prefer using is the PPE turnover, because PPE is what you're going to use as an asset to create your revenue. So those two are going to be extremely important. If we want to know the efficiency in managing inventory, then two important ratios would be the days of inventory that are outstanding in a company or the inventory turnover. The first one would tell you how much inventory does a company have. So if you only have 7 days inventory or if you have 1 year's inventory sitting in your warehouse. And the second one is going to be inventory turnover, how fast all of this process is going, buying inventory, selling inventory. These two are going to give you those factors. If you want to look at the efficiency in managing receivables, then you should look either at the receivables turnover or at the days of sales outstanding. These two are going to be similar to the inventory, but here we're managing all the receivables. And the accounts receivable are going to be crucial because they're also going to be part of that cash process that you may require. If you want to look at the efficiency in managing this entire cash cycle, then the two most important ratios would be the payables turnover or the days of payables outstanding. These ones are going to be telling you how much is it taking you to pay other people. Because all things being equal, you want to take a longer time to pay, you want to receive money in a short time, and you want to sell your inventory fast. So all of these ratios that I just said combined, the ones in managing inventory, managing receivables, and managing the cash cycle, are going to be interrelated into your efficiency of how is money flowing in your company. If you want to do a liquidity analysis, you would have to look at the current ratio or the quick ratio. These two are going to say how liquid is a company. But here you have to be careful in knowing if a company with low liquidity might be in a difficult position or not. Because if we look at liquidity ratios, for example, of Apple, they're not even going to cover one, which means that their current assets cover their current liabilities. But we don't have any doubt that Apple has money. So you have to consider what are the things that are being held in their current assets and their current liabilities, because this liquidity analysis will talk about these things. And now, when we want to consider a solvency analysis or the use of leverage within a company, we would look at two different ratios. We would look at debt to equity ratio. So this one will show you how much a company is having in debt versus how much it's financing itself through equity. And then the second ratio that's important would be the interest coverage. How much interest can you pay or can you cover from your things? So if we want to do now a profitability analysis, we would look at more ratios, because this is going to be the key part that usually shareholders want to look at when analyzing a company. There are 4 important profitability measures. The first one is the gross profit margin. The second one is the operating profit margin. The third one is the net profit margin. And all of these ones, if you know financial statements, then you know I'm going basically through the income statement where you have gross profit, operating profit, net profit. All of this, we're going to look at the margins, how much money you have left from your original sales. So if I started selling this, how much do I have from my operations? How much do I have net? This is going to be extremely important for our profitability. But the fourth one, it's the expense to sales. Also, this one will show what are the trade-offs between the profitability and the efficiency. And this is going to be important because usually if you had to decide between two paths, companies can either be profitable or they can be efficient. They can be efficient by lowering costs, being the cheapest in the market, selling high quantities, or they can choose to be profitable and sell at high margins but selling less. Those are basically the two paths for a company to grow. And the trade-off is you can't really choose both, or it's going to be extremely hard to do that. In a company that assimilates to doing this is Apple, but it's not a similar or replicable position. Usually companies will decide either if they're profitable or if they are efficiency, because this will have money in their pockets. But now, when we're looking at the actual money that's in the pockets, we might look at also 4 measures, and these ones are going to be usually referred to as the return measures. The return measures are going to be return on equity, which is the ROE. You may also have EWI, which is earnings without interest expense. You may have the ROA, which is the return on assets, and you might get the ROFL. And this one, it's going to be the return on equity minus the return on assets. All of this are going to be just return measures that's showing you how much a company keeps. But this will lead to a key point, and it's how I want to finish up my episode, and it's talking about the ROE, the return on equity. And why is this one important? Because basically here you can analyze lots of things from a company from an analysis that was created, and it's called the Dupong Analysis. In the Dupong Analysis, we're going to see different ways of understanding this ROE. If we look at that ratio alone, return on equity is going to be the net income divided by the shareholders' equity. It's easy. Return over your equity. But what we can do is that we can expand that formula. And we're going to expand it to see three things. First, the ability to retain profits. Second, the ability to use the assets for generating those profits. And third, the ability to leverage debt. And how are we going to see all of those things with just one measure? Basically just expanding up this formula. We could take it into three parts. First part, which is going to be your ability to retain profits, is going to be analyzed by taking the net income of a company, dividing it by its revenue. This one will show us how profitable a company is. How much is the company earning in revenue compared to its net income? Then, the second one, the ability to use assets for profits, is going to be taking the revenue, and this one will be divided by total assets. So if we take all the revenue and we divide it by our total assets, this is going to show us a proportion of how much revenue was created by the total of assets that a company might have. And then the third part is going to be the total assets divided by the shareholders' equity. And this is going to show us the amount of leverage that a company is using, because the total assets divided by the shareholders' equity will give us the proportion of how much debt they are using. If a company has debt, this might amplify its earnings, but it might also amplify its losses. So this leverage is going to be important because it acts as a magnifying glass. The good things will increase, but also the bad things might increase. So in this third part, you'll be able to analyze what that might bring to a company. And so we already have three separate ratios. Why is all of this related to ROE? We're going to multiply all of them. We're going to multiply net income over revenue times revenue over total assets times total assets over shareholders' equity. And what this shows us is that basically you would cancel out revenue from the second with the revenue from the first. You would cancel out total assets from the third one, from total assets from the second one. And then what you would get, it's just the net income divided by the shareholders' equity. So it's the same ROE, just in an expanded version. But this expanded version, that's called the Dupong Analysis, is going to give us a better understanding of how the company is using this money, it's generating all of its profits, and it's retaining them specifically, or using debt to leverage this earnings.